We shall commence this module by understanding the intergovernmental transfers. Intergovernmental transfers are the foremost source of revenues for different levels of government in most developing countries. The designs of the intergovernmental transfers is of critical importance for efficiency and equity of the local service provisions and fiscal health of the state and the local governments. In India, the Finance Commission's grants are for meeting the evaluated revenue gap of the states as also for various other purposes including for special needs and upgradation of standards. It is the determination of these grants that necessitates the Finance Commission to undertake a comprehensive examination of both the central and the state finances. Apart from the devolution of tax revenues, the states also gets grants in aid from the different institutions like Finance Commission, Planning Commission and some of the central ministries. Federal grants are a very important source of revenue to state and local regions. The basic principles of federal finance like independence and responsibility, adequacy and elasticity have to be coordinated. Various means like devolution of tax revenues are adopted to achieve this coordination. This module will highlight the theoretical aspect of the grants and how these grants are given by the Finance Commission in India. After studying this module, you shall be able to understand the various types of grants, learn about the general and specific objectives of grant in aid, understand the structure of grants in aid disbursed by the Finance Commission in India, understand the method and criteria used by the various finance commissions. Let us look into the theory of grants in aid. Grants in aid are a transfer of a sum of money from the central government to a state government either according to the provision of the Constitution of India or through a legislative decision. Usually, the grants in aid are used as a balancing factor to correct the maladjustments with respect to the allocation of sources of revenue to the central government and entrusting welfare functions to the states. Though the central government gives them the funding, but the state government must operate with the reasonable independence. Objectives of grants in aid. The general objectives of grants in aid are to reduce imbalance between functions and resources that may exist at a lower level of government, to reduce the regional inequality of governmental performance. The general purpose of grants in aid is to improve the quality or quantity of government service in backward areas by transferring funds from the developed regions through the central treasury. Third, to improve the intergovernmental relations. The specific objectives are: first, to promote development of services of the national importance and if possible to encourage the local participation in such services. Second, to reallocate the specific tax resources between the federal and the state governments as circumstances requires through the matching grants. Third, to compensate the losses suffered by the state government. Let us now discuss the types of grants. Intergovernmental grants can be broadly classified into two categories. First is the specific purpose or conditional or earmarked, and second is the general purpose for unconditional. Specific purpose or conditional. Specific purpose or conditional or categorical grants are intended to provide incentives for governments to undertake the specific programs or activities. These grants may be regular or obligatory in nature, or they may be discretionary or ad hoc. Conditional transfers typically specify the type of expenditures that can be financed, input-based conditionality. These may be capital expenditures, operating expenditures, or both. Conditional transfers may also require attainment of certain results in service delivery, which is output-based conditionality. There are several types of conditional grants. They are as follows. A. Matching grants. For every rupee given by the donor to support a particular activity, a certain sum is expended by the recipient. For example, a grant might stipulate that whenever a community spends a rupee on education, the central government would contribute a rupee as well. Matching requirements can be either open-ended, that is, the grantor matches whatever the level of resources the recipient provides, or closed-ended, that is, the grantor matches the recipient funds only up to a pre-specified limit. Matching open-ended grants are the utmost appropriate vehicle through which to induce state and local governments to increase the spending on the assisted function. Matching closed-ended grants is helpful in guaranteeing that the grantor has certain control over the cost of the transfer program. B. Non-matching grants. It offers a given amount of funds without local matching, provided they are spent for a particular purpose. Such conditions ensure that the recipient government's spending on the definite category will be at least equal to the amount of grant. If the recipient is already spending an amount equal to grant funds, some or all of the grant funds may be diverted to the other uses. Conditional non-matching grants are best suited for subsidizing the activities considered high priority by a national or a state government, but low priority by the local governments. Next, general purpose grants. General purpose grants are provided as general budget support with no strings attached. These transfers are typically mandated by law, but occasionally they may be ad hoc or discretionary. Such transfers are envisioned to preserve local autonomy and to enhance interjurisdictional equity. General purpose grants are termed block grants when they are used to provide broad support in a general area of state or local expenditures such as education, while allowing recipients discretion in allocating the funds among specific uses. Non-matching grants is unrestricted or general. No constraints are put on how it is spent, and unlike conditional grants, and no minimum expenditure in any area is expected. Since the grant can be spent on any combination of public goods or services or to provide tax break to residents, general non-matching assistance does not modify relative prices and is the least simulative of local spending. In some experimental studies, it has been witnessed that the proportion of these grants retained for greater local spending tends to exceed local government's own revenue relative to the resident's income. That is, grant money tends to stick where it first lands. This is referred to as the flypaper effect. Let us now discuss the grants in aid in India. Grants in aid are another important source of resource transfer to the states from the centre. Besides the shareable central taxes, grants in aid are mainly targeted towards achieving a degree of equalization. Grants to the states are disbursed by the Finance Commission Planning Commission and the central ministries. The finance commissions have been charged under Article 281B of the Constitution with the duty of making recommendations to the principal which should govern the grant in aid of the revenues of the states out of the Consolidated Fund of India. Statutory grants under Article 275 disbursed through the Finance Commission are meant to fill a gap which represents the state's expenditure not covered by its own revenue and share in the central tax. In addition to Article 275 grants, finance commissions also grant specific grants for upgradation of standards in various spheres of administration, that is Article 282, and also the grants for augmenting consolidated funds of the states for devolution of financial resources to the panchayats and the municipalities. These grants have been given to the states to reduce the disparities in the availability of various administrative and social services across states, to allow particular states to meet special financial burden emerging as a result of their particular circumstances, and to provide resources for specific activities considered to be national priorities. In fact, the grants in aid are considered as an important instrument to make the scheme of transfers more comprehensive and address issues spelled out in the terms of references. Unlike the devolution formula for the central taxes, grants provide greater scope to make the corrections for cost disabilities faced by many states. Constitutional provisions, that is principles and its scope. Grants and aids are an important component of Finance Commission. First, such sums as Parliament may by law provide shall be charged on the Consolidated Fund of India in each year as grants in aid of the revenues of such states as Parliament may determine to be in need of assistance, and different sums may be fixed for different states. Provided that there shall be paid out of the Consolidated Funds of India as grants in aid of the revenue of a state such capital and recurring sums as may be necessary to enable that states to meet the cost of such schemes of development as may be undertaken by the state with the approval of the Government of India for the purpose of promoting the welfare of the scheduled tribes in that state, or raising the level of administration of the scheduled areas therein to that of the administration of the rest of the areas of that state. Provided further that there shall be paid out of the Consolidated Fund of India as grants in aid of the revenue of the state of Assam sums capital and recurring equivalent to the average excess of expenditure over the revenues during the 2-year immediately preceding the commencement of this constitution in respect of the administration of the tribal areas specified in 232 part 1 of the table appended to paragraph 20 of the 6th schedule, and the cost of such schemes of the development as may be undertaken by that state with the approval of the Government of India for the purpose of raising the level of administration of the said areas to that of the administration of the rest of the areas of that state. 1A on and from the formation of the autonomous state under Article 24 to 244A. Any sums payable under clause A of the second provision to clause 1 shall, if the autonomous state comprises all the tribal areas referred to therein, be paid to the autonomous state, and if the autonomous state comprises only some of those tribal areas be apportioned between the state of Assam and the autonomous state as the President may by order specify. There shall be paid out of the Consolidated Fund of India as grants in aid of the revenues of the autonomous state sums, capital and recurring equivalent to the cost of such schemes of development as may be undertaken by the autonomous state with the approval of the Government of India for purpose of raising the level of administration of that state to that of the administration of the rest of the state of Assam. Until the provision is made by Parliament under clause 1, the powers conferred on Parliament under the clause shall be exercisable by the President by order, and any order made by the President under this clause shall have effect subject to any provision so made by the Parliament. Provided that after a finance commission has been constituted, no order shall be made under this clause by the President except after considering the recommendation of the finance commission. The first finance commission had considered the principles of determining grants at length and had opined that both the unconditional and specific purpose grants can and should be considered by the Finance Commission under the Article 275 read with Article 283b. Under Article 275, the first Finance Commission recommended the following principles for determining grants in aid. First, budgetary needs. The Commission observed that budgetary needs are an important criteria for determining of the amount of grants in aid. Several adjustments are however necessary to reduce all budgets to a comparable basis. Second, tax effort. The Commission observed that it is not enough to just consider the comparative poverty or affluence of the states as judged by indices of their relative per capita incomes, but it is also important to take into account the relative tax efforts of the states. This seems to the first mention of normative principle where fiscal capacity and tax efforts are mentioned as key determinants of grants in aid. Third, economy in expenditure. The Commission observed that allowance should be made for possibilities of economy in expenditure. The Commission observes the method of extending Finance Commission assistance should be such as to avoid any suggestions that the central government have taken upon themselves the responsibility for helping the states to balance their budgets from year to year. If the amount of grants in aid were to be merely in proportion to the financial plight of a state, a direct premium may be placed on impecunious policies and a penalty imposed on financial prudence. This seems to be the first clear explicit caution against following any gap filling approach. Fourth, standard of social services. The Commission observes an important purpose of grants in aid is to help in equalizing standards of basic social services. This is the first mention of equalization in respect of basic social services. Special obligations. The Commission mentioned that certain states may have special obligations or burdens likely to continue for a period of years, that is, commitment arising out of abnormal conditions. They mention as examples of abnormal conditions strain on the economy and administration and increased responsibility with respect of security. Sixth, broad purposes of national importance. The Commission favored that grants may be given to further any service of primary importance in which it is the national interest to assist the less advanced states. The first Finance Commission explicitly stated the best theoretically accepted principles that had emerged in literature for guiding the determination of fiscal transfers. The first Finance Commission recommended specific purpose grants for primary education. The second commission had observed that grants in aid should be residuary form of assistance given in the form of general and unconditional grants. However, they also agreed that grants for broad purposes may be given, and in respect to these, states should be under obligation to spend the whole amount in furtherance of the broad purposes indicated. The third Finance Commission gave specific purpose grants for improvement in the communications. Most of the subsequent commissions had generally agreed to the principles listed by the first commission, but they had all proceeded to primarily recommend unconditional revenue gap grants. In addition, some earmarked grants were recommended for special problems, upgradation of services and local bodies. However, as most resources are fungible and even if purposes are specified, states may continue to spend according to their own priorities by reducing the normal allocations on the specified heads. The 7th Finance Commission made some departures from the previous Finance Commissions while recommending capital grants to meet the capital expenditure as well. This was in recognition of the fact that revenue grants were not adequate for meeting the maintenance expenditure on administrative and residential buildings. The determination of grants required a comprehensive review of both the central and the state finances. The determination of these grants follow from two exercises carried out by the Finance Commissions. One, the assessment of expenditure of each state on revenue account, which could be non-plan or total, and two is the assessment of own revenues. Once tax devolution to each state has been determined, grants in aid are determined as a residual, which is the difference between the assessed expenditure and the sum of the projected own revenues and shares in the central taxes. Under the gap filling approach, larger transfers depends mainly on a larger gap in the revenue account in the past, irrespective of whether the available revenue capacity was adequately exploited or whether there was an undue growth in expenditures. This approach has often been criticized as it does not provide for fiscal discipline at the state level. However, of late, particularly from the 9th Finance Commission, there has been an increasing emphasis on a normative assessment of resource requirements and expenditures while recommending grants to the states. Under the normative approach, adverse incentives can be effectively neutralized as states are assessed in terms of revenues that they ought to raise given their respective capacities. Similarly, expenditures are assessed on the basis of needs consistent with an average or minimum acceptable level of the services and the relevant cost norms and are not driven by the past history of the expenditures. Now we will study the grants that were recommended under 13th Finance Commission. The Government of India has accepted most of the recommendation of the 13th Finance Commission on grants. Total grant to be provided by the centre to the state government over the 13th Finance Commission award period set at rupees 3,185.81 billion, which is more than twice the amount recommended by the 12th Five Commission. The Government of India has in principle accepted the recommendations that rupees 500 billion be provided to the states for the implementation of GST in accordance with the model which was recommended by the 13th Finance Commission. The implementation of the same has been deferred. Excluding this grant and the grant of rupees 50 billion each for renewable energy under the environment related grants and reduction in the infant mortality rate under the grants for improving outcomes, the balance amount of the grants recommended by the 13th Finance Commission at rupees 2,585.8 billion is 81% higher than the grants recommended by the 12th Finance Commission. This amount includes grants of rupees 875.19 billion for the local bodies, including a basic grant of rupees 563.35 billion and a performance grant of rupees 298.26 billion, which would be released by centre to the state for further transfer to the local bodies. After excluding these grants, the balance grants recommended by the Finance Commission at rupees 1,710 rupees 0.6 billion would still be 45% larger than the corresponding grants recommended by the 12th Finance Commission. The 13th Finance Commission has provided grants for the environment and for improving various outcomes of public expenditure. The latter includes, among other grants, for improving justice delivery, for improving statistical systems at the state and the district level, and for providing incentives for reducing the infant mortality. The grants awarded by the 13th Finance Commission for the environment includes grants for forest, water sector management, and an incentive grant for the grid connected renewable energy. The release of certain grants, including the incentive grants under the grant for environment and improving outcomes, as well as the performance grants for the local bodies, are subject to various prescribed conditionalities to ensure that the states comply with the overall agenda in these sectors. Let us now summarize what we have learned in this module. A grants in aid is a transfer of a sum of money from an upper government to a lower government with or without any stipulation according to the needs of the receiving government. Intergovernmental grants can be broadly classified into two categories: specific purpose and general purpose. Grants to the states are disbursed by the Finance Commission, Planning Commission and the central ministries. The Finance Commission have been charged under Article 280(10)(b) of the Constitution with the duty of making recommendations to the principles which should govern the grant in aid of the revenues of the states out of the Consolidated Fund of India. Statutory grants under Article 275 disbursed through the Finance Commission are meant to fill a gap which represents the state's expenditure not covered by its own revenue and share in central tax. Grants recommended by the Finance Commissions have generally been unconditional and largely based on the projected gaps between non-plan revenue expenditure and post-tax devolution receipts. However, of late there has been an increasing emphasis on the normative assessment of resource requirements and expenditures while recommending grants to states. Total grants to be provided by the centre to the state government over the 13th Finance Commission award period set at rupees 3,185.81 billion, which is more than twice the amount which was recommended by the 12th Finance Commission.